Impact of debt-to-income ratio on loans. The debt-to-income (DTI) ratio is a critical factor that lenders consider when evaluating loan applications. Here's how it impacts loans. 1. Loan eligibility. Lenders use DTI ratio to assess an applicant's ability to manage additional debt. A lower DTI ratio typically indicates lower risk, making applicants more likely to qualify for loans with favorable terms. 2. Risk assessment. A higher DTI ratio suggests that a significant portion of the borrower's income is already allocated to debt repayment. This increases the perceived risk for lenders, potentially leading to higher interest rates or denial of the loan application. 3. Interest rates. Borrowers with lower DTI ratios may qualify for lower interest rates because they are considered less risky. Higher DTI ratios could result in higher interest rates to compensate for the increased risk of default. 4. Loan amounts. Lenders may limit the amount of money they lend based on the borrower's DTI ratio. A high DTI ratio might restrict the maximum loan amount, even if the borrower meets other eligibility criteria. 5. Debt capacity. DTI ratio helps lenders gauge a borrower's debt capacity, the maximum amount of debt a borrower can comfortably manage based on their income. A lower DTI ratio indicates greater capacity to take on additional debt responsibly. 6. Mortgage loans. In mortgage lending, DTI ratio is particularly significant. Lenders typically set maximum DTI thresholds for different types of mortgages, e.g., conventional, FHA, VA loans. Borrowers with DTI ratios within acceptable limits are more likely to secure mortgage approval. 7. Creditworthiness. DTI ratio is a key component of overall creditworthiness assessment. Lenders consider both DTI ratio and credit score to evaluate the borrower's ability to repay loans and manage financial obligations responsibly. 8. Loan terms and conditions. DTI ratio influences loan terms and conditions, including repayment schedules, loan durations, and additional fees or requirements imposed by lenders to mitigate risk associated with higher DTI ratios. 9. Financial health evaluation. A lower DTI ratio generally indicates stronger financial health and stability, which can enhance the borrower's overall financial profile and increase their likelihood of loan approval. 10. Impact on future borrowing. Managing DTI ratio responsibly can improve creditworthiness over time, potentially leading to better loan terms and expanded borrowing opportunities in the future. Understanding the impact of DTI ratio on loans helps borrowers proactively manage their finances, maintain a healthy debt-to-income balance, and optimize their chances of securing loans with favorable terms and conditions.